There are high expectations for Tuesday's federal budget. Ottawa looks to take a balanced long-term investment approach in infrastructure and defense. Also wants to support industries hit by tariffs, but it also has to keep the deficit in check. There's a lot going on there. Andrew Hensick, senior economist with TD Bank Group, joins us now to discuss. Andrew, I know you're heading up to Ottawa for this one. We don't have a lot of detail from this government in terms of ahead of time of what to expect. What are you looking for?
Well, we're expecting a meaty one. The government, as you outlined, has a lot of priorities. But there are a few things we know are going to be there. We know the Build Canada Homes initiative is going to be there. We know that there are going to be substantial plans for increased defense outlays. We're also expecting a little more clarity on the major projects initiatives. We're going to expect to see the outcomes of the spending review with regards to how they plan to manage operational spend in the coming years. We know a few social programs have already been deemed off limits or been deemed safe. That's the $10 a day daycare plan, dental care, and school lunches. And you know, we're going to try and see what kind of strategy they have as the economy navigates these kind of structural changes.
I think the reason why so many people are putting so much weight on this budget is obviously the Canadian economy now faces challenges that we didn't face just a year ago. What is the economic context? If this is the budget that's trying to frame our economic journey for the next several years, if not decades, what state are we in right now?
We're in a bit of a tough go, right? So this is, you know, we're undergoing this kind of structural change where our trading relationship with the United States is changing. From our perspective, what that's resulting in is a period of pretty soft growth. You know, we're looking for growth in and around 1% annualized through the back half of 25, which is soft. You know, couple this with an unemployment rate that's rising around we're thinking around 7.2% by year end, and then staying relatively elevated through 2026. You know, this is a challenging economic environment. So to really get growth growing, the question is, okay, how's the government going to navigate this, and what kind of strengths have they identified and they're going to try and capitalize on?
The Carney government tapped you and said, what do you think we need to do, Andrew? If this is the challenge with our economy and it's growing, what things would you like to see that could actually make an impact for our economy?
So from our lens, we're curious to see how the government plans on addressing this persistent lack of productivity growth in the economy, right? So this involves, from our lens, two things we're looking for in the budget. First is these major projects, as I've talked about. How are these going to build on Canada's comparative advantages, right? Where are the places where we as a small economy can play and be successful, right? Is there going to be a link described between the projects themselves and these advantages that we're going to hope to capitalize on? The second thing is, are we going to see any kind of tax and regulatory reform, right? In terms of regulations, is there going to be some simplification involved? Really focusing on things where rules and initiatives where businesses might be finding pinch points, right? Are we going to see some simplification there? On the tax side, what kind of plan is there maybe to broaden the tax base or adjust statutory rates to make Canada a little more competitive, to help with this dynamism and with the investment that will ultimately help to grow our productivity and prosperity?
Doesn't sound like a magic bullet kind of budget. There rarely are magic bullets in life, right? I mean, it's going to take a mix of things. Could it be that expectations might be a little bit too high for this budget? If you need a mix of things that will take time, it sounds like.
Yeah, I mean, you know, the messaging has been there's going to be operational restraint along with capital investments that, you know, should take time, right? On the major projects, you know, the idea was let's bring the approval, the permitting timeline, you know, down to roughly 2 years, right? Which means that the payoff is going to be beyond that 2-year horizon. So I think, as with anything, you know, these are big initiatives, these are ambitious goals, but they will ultimately take time to fulfill. In the meantime, you know, there are economic supports that the government has already deployed. Are there going to be more in the budget? I guess we'll see. We'll see tomorrow.
If they're going to be big initiatives, people are expecting a bigger deficit than perhaps we were thinking about. What's your size around that in terms of their room to go deeper? Again,
I mean, the government's playing this pretty close to the chest. When you look at something like, say, the defense outlays reaching 5% of GDP, when you combine both the hard expenditures and the defense-related infrastructure, These are substantial dollar amounts, right? So what are the planned offsets? How is that going to be planned to be spent? The question is, though, what's the timing of that look like, right? Are those outlays going to happen in the near term, or are they going to happen further out? Some of these large capital expenses, the equipment might not be readily available. Same with the major projects initiatives. Any support directed towards the infrastructure projects, the funds might be coming down the line. So, huge uncertainty around in terms of a confidence in or around a deficit number. Something in around 70 billion-ish, maybe a little bit higher for next year. Seems reasonable, but again, the uncertainty around this best guess is substantial. We'll see what the details hold tomorrow.
So we get so excited when it finally gets tabled, and we do get those details. It felt like last week, even though Bank of Canada Governor Tiff Macklem didn't say, "Oh, over to you guys now, I've done all I can do," but it was sort of a clear signal from the Bank of Canada. They feel interest rates are where they need to be. They've done what they can do to counter a trade war. So when we do get this budget, how does it set up the Bank of Canada, and even our currency?
So from our lens, we've held, the Bank of Canada is now at the lower end of its neutral range, the 2.25. They've signaled, this is where they're going to pause. We think that's completely reasonable. We view them staying there through the entirety of next year. Several times it was emphasized the economy is going through a structural change. The relationship, our trading relationships are evolving. To the extent that the federal budget has significant outlays in the near term, that could affect the growth trajectory as we navigate this adjustment. That's not necessarily the base case. The base case is a steady, an expansion of the deficit, but not necessarily in terms of producing material upside to the inflation rates that the Bank of Canada would need to respond to. In terms of the currency. The Bank of Canada's we think, done cutting for now. The Fed still has room to go. The narrowing of the interest rate differentials, we believe, will add a little bit more support. I know the loonies had a bit of a tough go recently, but we think there's room for the loonie to appreciate vis-a-vis the U.S. dollar. Back at the end of this year, and then heading into 2026 as those interest rate differentials really start to narrow.